Welcome to our, oh, I've lost the screen. Welcome to our extraordinary audit meeting on the 22nd of March. Do we have any apologies?
No, Chair.
Thank you very much. And do we have any declarations of interest that need to be noted? Daniel, you have your hand raised.
Yes, thank you, Chairman. I need to declare a personal interest in items 55 and 56, as I'm a non-executive director of Woking Housing Limited and Berrybrook Homes Limited.
Thank you very much. Are there any others before we proceed? Nope, can't see any hands, so we'll move on. Public question time. Do we have any public questions?
No,
Can
Chair.
I declare an interest? Sorry, I wasn't quick enough.
Okay, Imogen.
Yeah, I've got a couple of years in the pension fund, so I'm declaring that I've got some money in there, and that's mentioned in all of this.
Okay, that's fine. Thank you. Yeah, sorry, there's no public question times. Thank you for that. Member question times. Do we have any members question times? Members questions?
No, Chair.
Thank you very much. Okay, we come on to item 55 on the agenda. This is the Woking Borough Council audit results for the year ended the 31st of March 2020. And these were sent to us as a supplementary agenda item on the Friday the 19th of March. So I hope you've all had the opportunity to receive them and to look at them. So I think for that we go to Helen. I think is that right?
It is, Chairman. Good evening, everybody.
Good evening.
So I'm sure Bob, depending on the questions afterwards, this may become a bit of a Bob and myself double act towards the end. But if I start off by introducing a couple of my colleagues who have joined me on the call this evening, who you'll see at the bottom of the screen. So Stefan van der Merwe, who is a manager who's been helping me out as Justine has been away from work for the last couple of weeks off sick. So Stefan has been providing me with some manager support, and Francesca Churchhouse, who's the senior, been working on the audit throughout the year. And they're here to provide me with any detail if you ask some really detailed and tricky questions on the contents of either the results report or the audit. Obviously, you've now seen this report. I think this is the third version of this report that you've seen. And I'm just going to have to flick between screens. So within the supplementary work document on page 4, hopefully what you can see there is sort of where we summarise the key changes to the previous version of the report that you saw at the last meeting. I suppose the highlights that I'd like to pick out is we have completed the detailed testing and detailed work around valuations. We've included a summary of the changes that have been made, although you will note that we haven't provided details against each element of the work as to the adjustment that's then come through into the accounts. And we've summarised it that there is a total of adjustment of somewhere between 45 and 50 million downward revaluation compared to the previous figures in the statement of accounts, and I'm sure that that's something that Bob and I will be answering questions on. We have agreed what adjustments need to be made to the accounts, but obviously when you are adjusting anything in relation to property, plant and equipment in particular, it hits so many different parts of the accounts that those values are yet to be fully processed and for us to audit them. So that's partly why we haven't included, sort of broken down that total number into the different elements. Sorry, I'm getting some feedback. But what I would say is we will be updating the audit results report for other matters, and so we will include that level of detail in due course. The details for that are on pages, so I wrote down my page numbers, so 15, 16, which I think are going to be something like pages, sorry, I am just flicking, page 16 onwards of the supplementary pack is where the detail sits. The second area that I wanted to pick up is our favourite for the last 2 years around the pension fund audit assurances. So we still don't have a final letter from the pension fund auditor. there's a slight difference in timescales that has been communicated in one sense to the council, which I'll let Bob talk about. But in our when we looked for an update at the end of last week, we were told that we should expect a letter potentially in the week beginning the 29th of March, but then they mentioned early April. Well, in the week beginning 29th of March, there's only one working day. So because obviously we then hit the Easter weekend. So I'm in all honesty, not expecting to have that information until after Easter to be able to work through it. The third area that I probably want to particularly focus on in relation to group accounting, and is picked up also in the cover report to the following item, is that we requested the accounting policies for the subsidiary companies and the council should be aligned. That again is a relatively complex piece of work, and it's going to involve prior year restatements. So we've had a number of discussions about what that might look like, and we are expecting to receive the updated disclosures in the next couple of days, and then we will check those disclosures through to the changes in the financial statements. Finally, we just need to complete our work around going concern, and that's the consultation process, which is a bit of a tricksy process to go through and will take a little bit of time, but that will, if it changes anything, it's likely to be in relation to the wording that is in the disclosure that the council has made, not our conclusion that the council is a going concern. So in essence, that's really what I wanted to say in terms of introduction. The other changes that are made within the account, within our report, are in the section 4, which is the area of audit differences, where we've summarised the differences above the values that we are expected to report to you. So that's probably all I wanted to say, Chairman, in terms of an introduction. I'm not sure if you want to take questions on this report, or if you want to hear from Bob and Mark on the accounts before we do that.
Actually, it might be as well to have listen to anything that Bob has to add, and to Mark before we go into the questions. It might be that they can answer some of the questions before they're even asked. So we'll go to Bob. Do you have anything to add to that, Bob?
Yes, I suppose if we're taking the next item at the same time, because it probably run concurrently, it would make sense. The accounts, as Helen said, are just about there from our point of view, apart from that one item around the pension fund. Graham had a meeting with the Berkshire Treasurers last Friday, and he was assured that there'd be something sent to him by next Friday, or this Friday coming up. I'm probably more inclined to go with Helen's estimate around it probably comes sometime the other side of Easter by now. But you never know, we live in hope. I think what we have said, though, is that the numbers we have from the pension fund have come through. We've agreed them with Ernst & Young, and we've applied them into the accounts. So we don't think the accounts numbers will change, subject to that final letter. It's more the fact that they put their audit conclusion in the letter that Helen and her team can review. There are, as Helen said, the case we just need to double check now that everything we put through in the primary statements has cast through into the notes. And I know Maria picked a couple of typos and a transposition up, which we'll correct and put right in the final version of the accounts. So they are all but finished, apart from just that final double check through, and then obviously confirmation that we've applied everything that we said we would apply in accordance with the audit and the audit report going forward. There is the one item where we have a disagreement, or is it disagreement? I suppose it is, a difference of opinion with EY, and that's around the Carnival Pool valuation. We've cast our valuation on a couple of things. We've based it on the capitalisation of the income, which is a technical term that I use in RICS, that multiplies up the annual income to give it a valuation. And that valuation came in at nearly £10 million. We also had a valuation based on the value, we think the market value of the property, and that was slightly under the original valuation based on capitalisation. So we've taken the midpoint between the two, and we come up with a valuation, I think it's 9.965. Now that is in excess of the valuation that has come from the Ernst & Young team, and potentially we feel it's because not Wokingham a special case, but the valuation done by the Ernst & Young team based on the southeast area rather than the specific Wokingham area, and we've got a valuation that we think is more accurate based on recent knowledge of a disposal in Bracknell of the Lexicon multi-storey car park. Far bigger car park, but doing the pro rata per space allocation, that's where we come with our valuation that is probably over 4.5 million in excess of the EY valuation. But at this stage, I don't feel that we are being fair to our valuers, who are professional RICS valuers, same as Ernst & Young's, if we then went against what they're telling us, and they're telling us it's significantly valued more than the EY estimates. It's those things that happen. You can get two valuers in a room and get three values normally. It's one of those funny things that happens. Hopefully there's no valuers here, so I don't upset anybody, but we do have Craig Hogarth on standby if you do want to challenge on the valuation around the Carnival pool. Other than that, as I say, we will go through the accounts, we will produce a final version, and as I say, I'm not expecting anything now to change in terms of the numbers. There may be some changes around the narrative on the going concern, but it is around the words we put in, then how we put the words in, rather than the fact that Wokingham is not a going concern. Wokingham is a going concern. All local authorities basically are a going concern, but I think if you look at the recent SIP for Resilience Index, it puts us in the top 20 unitaries in the country in terms of resilience. And certainly we've probably had a better pandemic than some of the others, if you could say there's a good pandemic. Mark is on hand, the Chief Accountant, to answer the really technical questions. So I'm happy to throw it open to questions now as well, Chair.
Okay, thank you very much. I see that Maria, you have your hand raised, so over to you, Maria.
Yes, so I've got a few questions, but I'll just ask a couple at the beginning and then come back to them at the end, just in case anybody else wants to jump in. So I got a little bit confused about this audit results. Has this 45 to 50 million pound adjustment been put through? Because when I read different parts of the audit report, it didn't sound as, in some places it didn't sound as though it had, and in other places it did. And I was getting really confused about that.
So in terms of has it been put through or not, and apologies if it's not entirely clear in the report, probably because we were trying to get it out on Friday as quickly as possible and things were still moving. The 45 to 50 million adjustment will be made to the accounts, and that's what's set out in the covering report to the second item. What I haven't included what we haven't included at this stage is how that is made up. So within our report. So I think probably what we were trying to say is what we have not done is checked that all of that has gone through as we expect and gone rippled through the notes as we would expect. So we haven't put that level of detail in.
Right. So has the write down been made in the set of accounts that we can see that was attached to the audit results report?
I think that's a question for Bob rather than myself.
Oh, right on time, Mark.
Good evening, everyone. In terms of that, those specific adjustments, they haven't been included in the pack that was sent across. So I'm not sure what page number it is, but we listed the adjustments we've agreed with the auditors in terms of how we've gone from our draft accounts to our latest position. And then once we've agreed the numbers with Helen and her team, we will add in those asset adjustments as well.
Okay. There's another two questions, then I'll let somebody else have a go, and if not, I'll come back. So this difference on the Carnival Pool car park. So Helen, why weren't you able to accept the valuation that the council officers commissioned for the car park?
So how we do our valuations work, where we've selected a sample of assets and we ask our experts to look at it, is that they will take the information that your valuers have used and look at it through their lens to a certain extent. which is going to be obviously at a higher level than your own valuer, who you would expect to be able to provide a very specific Wokingham Borough Council lens. We don't come up with a specific number because that's not our job, but what our valuer will do is give us a reasonable range within which he would expect the valuation to fall. For the sample of assets, and 11 were selected in total, one of them, which was Carnival Pool, has fallen outside of the range. There was a bigger difference when we started the work, but there have been, so our valuer came in with a much lower range than we've eventually ended up with. Your valuation specialist, who obviously knows the asset much better, had a slightly higher number. So through a sort of series of challenges and discussions, the two have kind of come closer together, but our range, the top of our range, still falls below the actual valuation that your valuer has used. What we're not saying is that you're wrong, nor are we saying that we are right. But in most cases we can usually get to much closer to the difference. And on Carnival Pool, I think it's relatively new asset with not an awful lot of sort of back data, as it were, to support the valuation. But as Bob mentioned in his introduction, obviously your valuer has a more specific local knowledge than our valuation specialist would do.
Okay. So this causes me a significant problem because we have been told as individual councillors and as the council as a whole that we can rely on the accounts because the auditors have looked at them and basically they've agreed all the numbers. Now, I know this is a difference in judgment, but now that's been violated in terms of what the leader of the council has said, the reliance we can put on the accounts. So I'm not expecting anybody to answer that. I'm just expressing an opinion. So my last question is valuation of investment properties. So there's a note right at the end of the accounts about how investment properties are valued and the fact that if they're outside Wokingham, then they definitely are investment properties. However, in the interpretation of the of what properties should be investment properties, there's a statement that if they're in Wokingham, then they will not be investment properties. And I'm interested in that because while it might seem necessary for them to be outside Wokingham, to be not necessary for them to be in Wokingham to be property, plant and equipment, I can't see why that's sufficient reason. So it may be a necessary reason, but I can't see why it's a sufficient reason, the fact that something is in Wokingham, for it to be moved to property, plant and equipment. So an example I wrote to Bob about is that if we purchase the Holiday Inn, for example, I can't see how the fact that that is in Wokingham is both necessary and sufficient for it to be property, plant and equipment rather than an investment property. And I really don't understand that. It's the sufficient rather than the necessary that I don't understand.
If I may answer the first point, I know you didn't want a response, Maria, but I think what I would say is we are content that the accounts are materially accurate. So even though there's a difference of opinion on Carnival Pool, it doesn't undermine the validity of the financial statements because the difference is below our tolerable error, so our performance materiality. So it doesn't, the accounts remain materially correct, and I think it's important to note that. In relation to the investment property point, and I'm sure Bob will want to come in on this as well, the SIPFA code is very clear that an asset can only be designated as investment property if it is solely for capital appreciation.
Yeah,
I think it is, whilst I would sort of tend to agree that just because an asset sits within the borough's boundaries, it can't be IP. I think it becomes very, very difficult to decouple what is solely for capital appreciation and what is also going to be there to benefit the either economic redevelopment or regeneration or anything like that. So with the properties that are currently owned and the way in which they have been part of the regeneration schemes, I think we remain of the view that the assets that are categorised as investment property are properly investment property, and the assets that are in PPE are properly classified as PPE. Bob, I don't know if you want to add something to that before.
So just to clarify, so the reason that the Barclays Bank, for example, is in investment properties is because it was purchased before the current regeneration.
The Barclays Bank property is again part of our protection of the high street and the town centre redevelopment to ensure that it remains as a commercial building and activities.
So why is that in investment properties then?
Barclays Bank is not. I think the only two properties in investment properties, and Mark will correct me if I'm wrong, are the Wicks building in Basingstoke and the Stapleton's Tyre building up in Peterborough.
Okay.
Barclays Bank, I believe, is under the other land and buildings within the Wokingham Borough. I think that's right, Mark, isn't it?
Yeah, I think so.
Fran has confirmed that it's right. So Barclays sits in PPE.
Okay,
Wicks and Stapleton's.
Which just Wicks and Stapleton's.
Right. Yes. So your point about something like the Holiday Inn is certainly a valid point. However, the current guidance around what we will invest in and what we're allowed to invest in following the changes with the government is that it must have either an economic development regeneration or a housing element to it, or a protection of assets or employment within the area. So as we're no longer investing outside of the borough, because that was closed down to us, so the investments we did make are all in accordance with what we were allowed to do at the time, and there's been no requirement from central government or the Treasury to make us divest these properties, although obviously we will probably divest for them at the opportune moment that makes the best value for the Borough Council. They will remain, but everything else now that we acquire will be within the borough, and it will be for reasons not, well, the reasons are now primarily for regeneration, economic development, protection of an asset or employment. And all we are saying is that they need to be also behind a strong financial business case behind them that will mean that they end up not costing the taxpayer money to acquire them.
Okay, thank you.
Come off, thank you. I think we've got Imogen would like to speak next.
Sure. On Maria's point just then, so where does the Marks and Spencer's building that is technically part of the regeneration project, where does that fit? Is that not part of the regeneration of the high street, or where does this fit into this category, and how is that valued as well?
I believe it must sit under the town centre regeneration side of things, so it'll be in other land and buildings as well.
But is it not property assets that belongs to the council?
Yes, so we'll be sitting on our other land and buildings, part of the PPE on the balance sheet. And
PPE, is that revalued annually, or is that revalued every 5 years?
There's a revaluation cycle that's in our accounting policies that are in the accounts. So they're valued on a rolling programme. All councils, as far as I'm aware, that I know, will have a revaluation programme. So you're not revaluing every single asset every single year, because the idea is that they will not move a great deal over the valuation period. But what we do, sorry, I can just finish, that we will pick a certain number of assets that we believe may be suffering from a downward or upward valuation based on market conditions, and ask that they're done annually. We will do a desktop valuation that allows us to say that none of the assets we have significantly moved over the year or over the period since the last valuation. And that's part of the work that we've been doing with Helen and Francesca and with Mark and with our valuers. And it has gone on for a fair bit of time. But I think we're now in a position where we believe the values that are shown in our accounts are materially correct and accurate to the agreement of Ernst & Young, apart from the Carnival Pool one. Just as a point, the investment properties, although they fall under PPE, they have their own valuation cycle, because when we started doing these, we put in a special minimum revenue provision for these properties based on an expected or not expected, but a worst case scenario where we might see a downward valuation, because these are asset backed, in that we can sell the asset to liquidate and pay for the debt if we needed to, and we don't probably intend to, but we would if we had to. But to be prudent, we decided that a revenue provision of 10% over 15 years would be prudent. And we had these discussions with Helen and her team, I think 2.5 years ago, I think, when I first came in. But we also agreed that we would do a valuation on those properties every year to ensure that we are not moving and under providing. And if we were to be under providing, we would make a voluntary revenue provision at some point, but it has to go through the budget papers to make that provision in the first place.
Thank you for that, Bob. But for what I understand, the old Marks and Spencer's building in Wokingham is neither an investment property, and it probably comes under it comes under just under the regeneration. You think it's PPE, but it wouldn't be revalued on a regular basis like that because it doesn't fit under that category. And as far as I can see, it's a fairly large and tangible asset that we have. So my concern is it's, you know, while I get it if it's a school or something like that we own, you know, we were not planning on selling the schools usually. For something like that is a Marks and Spencer store, it's going to change with the financial climate that we have at the moment. Which for, you know, high street stores is going to be, I wouldn't expect it to be worth as much as what it was worth a couple of years ago. And my concern is that store is not being revalued on the regular basis that you are doing for other commercial properties that we have around. Hopefully that makes sense.
I understand your question. I will plead a certain amount of ignorance on the Marks and Spencer store. It wasn't there since I've been in Wokingham, so that shows how long ago it went.
My concern is it's kind of invisible because it's owned by a project. And
I believe it was part of the town centre regeneration Peach Place works. So we'll be wrapped up within that town centre part. If you wish, I can take away and obtain a further valuation or question on the valuations on where it is, but that had to come from Bernie Pitch's team, certainly.
It would be, and I know the report talks about Berrybrook Homes and their valuation of the Peach Place properties. I'm just kind of concerned as to what's happening with the town centre regeneration project with these things being revalued, and that it's just setting me off on a wobbly course or sideways, I guess. I'll let somebody else ask questions.
Thank you very much. Sorry, did you want to come in, Mark?
Yeah, I was just going to add to that. So in terms of the regeneration property, so as part of the 45 to 50 million pound downward revaluation, there are a handful of assets that have gone up in value, and these are particularly around some of our regeneration properties. So where we've recently purchased an asset, they're held on our balance sheet under asset construction, and then when they become operational, they move into PPE. And the council's current policy is we revalue those the year after they become operational.
Okay.
From speaking to EY this year, we decided to look at some of the regeneration properties, in particular around Elmsfield and Peach Place, and those have seen an increase of £3 million, so a 7% increase on those particular assets.
I would see that because they're new things, they're new shops that have opened. We had a bit of wobbly when Dornus went bust, so that's obviously cost us some extra money in terms of the regeneration. But I'm just a little concerned that the Marks and Spencer store that was acquired and is kind of sitting there, it's got a tenant in it, but you know, it's obviously, and what I suppose the most valuable thing comes with that is the car park, which is not really being used much at the moment. And I'm just kind of concerned about how the whole project stands. And I agree that obviously with the house we've got residential properties being sold and things, so it will probably as a whole be making some money, but I'm just wondering if there's some elements of it that we need to worry about. That's all. Thank you.
Thank you. Daniel, you have your hand raised.
Yes, thank you. A couple of questions for Bob. So I think in the audit report from EY, there is a suggestion to amend the cyclical PPE valuation program. So it's, you know, rather than revaluing every category type every 5 years, you're doing kind of like a proportion of each type every year. I just wondered whether it was the council's plan to move towards that position, or whether that's still being thought through.
Yes, thank you, Daniel. I would say that it's certainly my plan to try and move us towards that. I believe that it offers us the ability to get a basket of goods valued each time, which will give us a proxy for the other items that are not in the basket. So we can then, if needs be, do desktop valuations on those other similar asset classes going through. So I would suggest it is good practice, and certainly the practice I've had at other councils where I've been, where we have that mixed basket of goods for revaluation. We do have the policy in there that we can also specify to the valuers certain items that we would like to be revalued if we believe there might be an impairment or a downward valuation on the, so an impairment being on the asset itself, or a downward valuation being based on general market conditions for that type of asset across the in the area and the region. So, but I think the proposal that's come from EY has been in discussion with us, so they're not sort of springing it on us as a you must do this, and it was partly our idea that we would go for that. But it's good to have it in the EY report, because it gives me a bit of ability to say this is good practice and this is what we want to do, and that's what I'm trying to get to. And again, if Audit Committee would like to support that recommendation, I'll be even better.
If I may, Chairman, just to come in on that particular point,
Yeah.
I'd absolutely endorse what Bob has just said in terms of, this has sort of been a joint discussion between us as we've gone through the valuations work this year. So I think it was something that Bob was already contemplating, was a change in the way in which assets are valued, and what we're doing within our report is effectively endorsing that as a good way forward. I think some of the problems that we have encountered this year have come from the increased focus that we are putting on valuations because of the increased focus on us by our regulators in terms of what we are doing. But if we can move to more of a cycle where I like the phrase basket of properties is reviewed each year, it gives a sound basis for them being able to apply that and to be able to be have more confidence that the accounts are materially, or the valuations are materially correct at the 31st of March of any given year. The other point, perhaps linking back to the previous conversation with Imogen, is that moving to that sort of cycle, which is driven more perhaps from the finance team around, if that there are particular events or factors that would affect the valuation of a property. So if you have properties sitting in PPE that are more subject to market variability, then you can get those revalued on a more frequent basis, or as and when it is needed, as opposed to waiting for 5 years. And I think that will help in terms of reducing some of the swings in the valuation that we've seen.
Thank you very much. Perhaps the valuation proposal should come to a future Audit Committee meeting, so if that could be noted, something to add to our future agenda items. Okay.
Sorry, just saying that, Chair, we normally do bring in our accounting policies or any changes to our accounting policies to the committee before we start compiling the next year's accounts. So we'll make sure that is in that accounting policy part of the agenda.
Thanks very much. Thank you. Okay, I note, Maria, you have your hand raised. Is that from last time, or are you asking?
I'm asking another question. Thank
right,
you.
okay.
Can somebody explain to me what this REFCUS thing is, please? Because I don't understand what effect it has, well, on anything really.
I can start off, but I'll let Mark in simple terms, it's well, the abbreviation stands for Revenue Expenditure Funded from Capital under Statute. The council or local authorities are allowed to fund a certain element of their revenue costs from capital if it meets certain criteria. Up until about 5 years ago, you had to apply to the Secretary of State for Ministry of Housing, Communities and Local Government for a Secretary of State direction to capitalise some revenue costs. When we had the first of the 4-year settlement that came in 2015-16, I believe it was, but I will stand corrected, they said, provided it's in our plans, and it is in our plans, we can capitalise transformation costs. So basically, it's a transformation cost that would normally would be revenue, but because it gives a longer term benefit to the council, they allow us to fund it from capital. It's part of the fact that local authorities are restricted with what they can spend their capital receipts on. So therefore, the government has given us this direction, and it does get looked into quite a lot.
Okay, so this 6.7 million that's been, so this was something about a lease premium, but because it's our subsidiaries, then it couldn't be, or whatever. Has this had any effect? Because I was looking at the statement of adjustments. Has it had any effect on our net income line or not? I noticed there's an adjustment to gross income, and there's no, I don't understand it, to be honest. Has there been an effect on our bottom line, and has it had any effect on our general reserves, this reclassification?
I think the answer is no, but I'll let Mark do the technical bit, if you don't mind, Mark.
So as Bob says, there's no impact on the council's usable reserves. With this particular £6.7 million, so we had treated that as REFCUS. So as Bob says, with REFCUS, that's in effect capitalising revenue expenditure. But then what we do is we review that expenditure. If it creates an asset, the expenditure is added to the balance sheet. If it doesn't create an asset, or it's expenditure on asset we don't own, that REFCUS expenditure and how it's funded, so the REFCUS income is not put on the balance sheet, it's put through our income and expenditure account.
Yeah.
So in terms of the 6.7 million, we had treated that as REFCUS, so we had shown a 6. In our cost of services and a matching £6.7 million income in our cost of services.
Okay. So it came in as income and it went out as an expense, but it should have gone through some sort of capital adjustment accounting thing.
Yeah, and the discussion with EY was that this is not REFCUS, it should be treated purely as a revenue grant to the subsidiary companies, and therefore the funding is also revenue. So the adjustment.
No.
It was originally, but we agreed with EY that it should be treated as a revenue grant. So that's why the adjustment is taken out. The income, instead of showing against cost of services, we show it against the general taxation and grant line, which is what we do for all revenue grants.
Okay, so it's income and expenditure, and it's cancelling adjustment.
Yeah, net nil impact on the balance sheet and usable reserves.
Okay, thank you.
Okay, thank you. Daniel, you had your hand raised. Is that it's down now? Did you wish to speak?
No, it's down now. Sorry.
Okay. Thank you very much. Are there any other questions, any points anybody wishes to raise before we leave this particular item? Maria?
Yeah, I've just got a couple of questions on the actual numbers, apart from the ones that I sent to Bob. It was just about the notes for debtors, I think. I was just wondering why there wasn't anything in the group column. There wasn't any this year or last year. And I think it was the group, the debtors, and also the creditors. Are the numbers going to go in there, and that's what we've been talking about, or is it an error, or I don't understand it really?
I can answer that one. So, in terms of the group, so as Helen mentioned earlier, that part of the work we have to do now is consolidate accounting policies, and then alongside that is also to expand some of the specific notes in the accounts where they're material.
Yeah, note 30 I'm looking at. So there's going to be an adjustment, a restatement of prior year and this year, and that's why there's nothing in the group for short-term debtors.
Yeah, so when we update the final figures, that was purely just to get template of the note ready. What we will have is a breakdown of the group position for debtors and creditors, as well as note 24, which is the PPE. So we'll have that as broken down as per the group consolidation position.
Yeah, okay.
Thank you very much. Angus.
Thank you, Chairman. Just before we move on, can we understand, assuming that we do get the pension report just before or just after Easter, and Mark consolidates all the bits that he's been talking about, when will we see this to see the end of this before? Well, we've missed before the end of the new period, but obviously it'd be best to get it out of the way. I'm sure Bob would be very keen to get this out of the way.
Yes, certainly, Angus, and I believe it's one of those how long is a piece of string type questions and answers. I believe that the amount of work that we have to do as the financial accountants of the council, and potentially the work that Helen and her team have to do, is probably a week away, just to put those consolidations through and do the casting checks through the numbers and get final confirmation with Helen's team that they are happy with the adjustments made. As I said before, we believe the pension numbers we have in the accounts are correct now, so there's no real adjustment to the numbers. It's just getting that final bit of confidence, around the going concern narrative from Helen after she's done her review, and also the pension letter that will come from Deloitte. Once we have that, we believe the accounts are complete, and we will have done that double check through. I suppose, best will in the world, it will probably become after Easter now, and I will propose that I would at that time, once we have it complete, is circulate the statement of accounts as they're correct for publication. I'll circulate the letter of representation which we have to write on behalf of the chair and the chief finance officer of the council, which has to be signed as well, and obviously Helen's updated report when that comes through. And once we have that, that would be the point where I believe we'll be able to sign the accounts, and we'll be able to go to publication with them to put them on there. We are not the only local authority in Berkshire that hasn't produced their accounts this year, due to the pension part of it. And there are quite a few local authorities, I believe, that are late on that thing. It's not a good place to be, but I believe given the pressure we've been under as a team of accountants for the COVID pandemic, trying to support all the COVID payments and accounting, and also setting a budget under a COVID situation. And I would say the audit this time hasn't been helped by the fact that normally we'd sit down face to face and talk things through with the auditors. It's a bit different on Teams. I think we've adapted to it, but it's not the way it was before, and that's made it a bit more difficult. Hopefully next year we'd have learned lessons and we'll be going through the right way.
Yes, I'm sure we all understand the particular issues that we faced over this year. But just thinking that in the time of this particular committee, we would like to see it through, as we've lived with it. And I'm just wondering whether any involvement with us will be instructed by PERDA.
I'd defer to Andrew on that one if he's here.
Yeah, Andrew is here.
Yes, good evening, members. Ideally, the committee wouldn't meet during PERDA, and the decision or the recommendation made in the report, if I refer you to recommendation 4, is that the committee would agree to delegate the authority for the final signing to the chair. So delegate to the chair of the committee the authority to sign the statement of accounts and the letter of representation, subject to there being no significant changes from the final review by the external auditors. Obviously, there is that caveat there in the recommendation should there be any significant changes. But I think that the recommendation that you've got in front of you this evening is quite clear around what's being proposed.
Can I just say that my understanding is it's not just the chairman, it's the chief executive as well who would have a look at this at the same time.
It's the deputy chief executive chair.
Sorry, yeah.
It has to be the Chief Finance Officer, Section 151. Helen's got a point.
So the chief executive would also be involved in terms of signing off and redating the annual governance statement as well, as the other point to make. So there's a number of people you just need to line up to sign off, but as it states in the cover report, the delegated authority is really to the chairman, I believe, and the Section 151 officer, Graham Evers.
Thank you very much. Okay. Right. Are there? Yes, Maria, you have your hand raised.
Yes, sorry, my computer's almost run out of juice, so I'm on my iPad now. I think it's too early for us to delegate this, and the reason I think that is because recommendation 2 is note that accounts are substantially complete except for a review of the work of the external auditors. But we've still got the 45 to 50 million pounds to go through, and I would say that the difference between 45 and 50 million pounds is 5 million, which is above the materiality limit of 4.765 or even 4.999, and I just think it's too early, and I will not be able to agree with the recommendation because I just think it's too early, and I understand there are problems with PERDA, but I think we have to wait.
If I can just clarify the figure, I think we're working on it is 49 million now, isn't it, Mark? The 45 to 50 million was a range whilst we were still finalising. The finalised figure is 49 million.
Yeah, I can't delegate something when 49 million pounds worth of adjustments hasn't gone through. I'm sorry, it's not just a pension scheme.
Okay, right. If there's no further questions, what we need to agree then is, first of all, whether this can, as far as I can understand, be delegated to the chairman and the deputy chief executive to look at this, and then providing, as we said, there's no material changes, to agree it. So that needs to go to a vote, I believe. Okay, so can I ask then that those that are in agreement of the delegation being given to the chairman and the deputy chief executive, those in favour, could you please raise your hands? Right, I'm trying to see. I've got 1, 2, 3, 4, 5, maybe 6. I don't know whether can anybody see any more? I've got no, wait a minute. 1, 2, 3. I've got 7. Is that right?
I've got 4, Chair.
You've got 4. I've got 4 on the screen, and then
I can only see 4.
You can only see 4. I'm looking down the bottom and on the participants, so I can see 4 on the participants. Yes. Okay, so there's 4. I will add mine at this stage, but I'm voting really for something myself, so that's 5. Can I see those against, please? And that's 2 against, so that's 6. Without adding up, how many we got on the committee? Is there one that's abstaining? Is there anybody abstaining? No. Okay, as far as I know. Okay, so that is carried, that it will be delegated to the chairman and the deputy chief executive finance officer. Thank you very much. Okay, we move on to item 56, which is statements of accounts, and I think that comes to you, Bob. You've got to add to that?
I think that's one we just voted on, Chair.
Oh, sorry, I'm missing. Sorry, I've just missed that one. Okay.
We put the 2 items together, I believe.
Yeah, sorry, I've just looked at draft annual audit committee report. Sorry. So who's presenting that one?
Chairman, I can introduce this. So
yes.
This is a draft for the audit committee to consider to report to council. So the proposal would be to report this to the next meeting of the council in May on the work of the committee.
Can I just clarify? Have we just voted on 56 and now we're going to vote on 55?
55 was to receive. 56 we actually voted on the delegation.
Yeah, I just want to clarify what we were voting on. Yes, just to make sure it's the right way round. Yeah. Right.
Okay. Andrew.
Yeah. So this is the draft report for the committee this evening to consider for it to be proposed to council at their next meeting in May for council to note the work of the audit committee during 2020-21. So it's intended as a factual representation of what the committee covered during the year, but be interested to hear any additional points that members would like to see in the report that goes on to council in May.
Okay, anybody have any comments?
Sorry, is this item 55? I'm getting very confused about
57.
57, yes.
Oh, so we're not voting on 55.
Well, we took 55 as a to receive. We didn't vote on it.
So we don't need to vote on that.
No.
No, that's fine. Okay, I'm clear now. Thank you.
Okay. Sorry, back to you, Andrew. We're on any comments on the draft annual audit committee report? Any hands raised? No. So that seems to be accepted. Well, we have one. Maria.
Yes, I'd like to raise an issue about governance, which is part of what we're looking at, I think, if I remember reading it rightly. So we're talking about governance, and I would like to raise my disquiet that the council can apparently vote against any item of its corporate local code of corporate governance and or its own constitution, the constitution being the more important. The local code of corporate governance is, of course, within the constitution, and I don't think that is a very good way of being constitutional and being and having good governance. So I would just like to raise that as an issue. I just don't understand how the council can just change its constitution when it likes.
If I could respond to that, Chair. So I think in terms of this report, as I say, it's about a factual report back to council of the work of the committee over the year. I think the issue that Maria raises is a broader issue. I know that is something potentially that Overview and Scrutiny may choose to look at during the next municipal year. I'd suggest we wait. I think the meeting is tomorrow evening, Overview and Scrutiny, so I suggest that we wait to see whether that's something that Overview and Scrutiny would like to look at in terms of those broader issues that Maria refers to.
Okay, thank you.
We can't hear you, Bill. Can't hear you.
Sorry, talking to myself. Okay, we have no further questions, so we'll go on to, first of all, receive the draft annual audit committee report to consider that, and the second is to recommend to the report to the executive. So I think we need to vote on that we are happy to recommend that to the executive. So
council in the agenda, Chairman.
Yeah, sorry, Chairman, it's to council, not to executive. You're on mute, Chairman.
Lost me. I keep losing it. Can I have a show of hands for those who are in favour of this being recommended to council? Okay, I'm trying to raise mine. I can't get down there. Mine is raised as well, I should say. So we have, I see 6, and that would be mine 7. So I think that's unanimous.
Mine is raised, Bill, but it's not showing as raised. So
it is on the screen. I've got that one. So
that's fine, thank you.
Yeah, so we are okay with 7. So I believe that is carried. Thank you very much. Okay, so yeah, if you can put your hands down. So I think we're happy there. So I think that brings us to the end of the meeting. Unless there's anything else that anybody has in mind to mention, I will say a very good thank you very much, and congratulate everybody on finishing at 5 to 8.
Assuming, Chairman, this is the last meeting of the municipal year.
Yes.
May we thank you for your chairmanship this year.
Well, thank you very much. Yes. And thank you to everybody on the committee for bearing with me and joining me at these meetings.
Have a good election is all I can say. Thank you, Bill.
Yes.
Have a good election as best as you can.
Thank you, Chairman. You did it well, and to get it finished by 8 o'clock.
Well, yes. I go down in history for that one, can I?
I think so.
Is anyone leaving us? Oh, yes.
Early bath.